Welcome everyone to HueFin News. Today is June 9th, 2019. Give you all the news according to the chart because the market doesn't follow fundamental analysis. It doesn't care about the company's assets, liabilities, earnings, production, GDP, business performance, anything of that nature. The only thing that really matters is what one is willing to pay for an asset. That's it. So we're going to talk about what can cause the next stock market crash. It was an article written by Monday Morning. Right here on the left side of our screen, we're going to look at it and see if it correlates over to the price charts from the last couple of weeks, because the last time we did our video for the stock market was on May 12, 2019. Go back and check out that video. It is in a playlist if you guys want to catch up and see what we said concerning these three major indexes for the United States. Before I get started, make sure you all continue to go ahead and like and share these videos. Continue to subscribe, hit that bell notification so you all become notified when we upload this fantastic and easy to understand content. And as well, check us out at our website HueFinancial.com in order to get more information pertaining to price charts. So now let's dive right on into our article for today. The title of it reads, "This is what could cause the next stock market crash." I have went ahead and highlighted some important things that this article tries to point out concerning what could cause the next crash. First one is the trade war with China escalates. Now, if you all can tell and been looking on the news, it continues to see that the United States continue to impose increasingly high amounts of tariffs on Chinese goods entering the United States. That is what they are talking about when it writes trade war with China escalates. Okay. Next one. The upcoming presidential election could be the final push that sends the markets tumbling. The Democratic candidates right here at the United States is continuing to pinpoint some of the financial markets, the stock market, Wall Street, and trying to impede on their advances on how they make financing and funding, and trying to eradicate literally stock buybacks. Okay. And that's why I went ahead and highlighted this portion right here, reining in share buyback programs. The Democratic candidates, which this article goes into, I will have a link of this article in the description of this video so you guys can continue to read upon it if you're interested. Banning stock buybacks will also dry up the demand for stocks, which is a virtual guarantee of a new bear market. This article insinuates that this is the reason why the stock market has seen a substantial increase in price to the upside, because corporations, pension funds, hedge funds, all these other companies and institutions have been buying back their own shares. Restrictions like this are becoming more likely since several Democratic presidential candidates have indicated a desire to restrict some of the excesses on Wall Street. So this is what can rein in the new stock market crash. Here are some of the Democratic presidential candidates that are trying to restrict stock buybacks: Senator Bernie Sanders, Senator Elizabeth Warren, and former Vice President Joe Biden. This is the reason why stock buybacks are a popular political target. When you look at stock buybacks, it has played a vital role that have caused the bull market run that began in 2009. You can see right here on my chart that in the NASDAQ, the S&P 500, and the Dow is when the market saw the start of the bull run back in 2009. And since 2009, the report that came out from Goldman Sachs reveals that corporations finance their own stock buybacks. They account for over 90% of the net purchase of their own stocks. Henceforth, the reason why you have this massive movement to the upside. Share buybacks are in jeopardy from this major catalyst. Share buybacks haven't been happening by accident. Companies have been using the cheap cost of borrowing money to finance their buyback programs. Many companies have taken on serious debt to repurchase their own shares lured in by the Fed's near zero interest rates. With zero interest rates, corporations are able to finance cheap money in order to buy back their own shares, which puts on a facade that the prices of these companies, or that these companies are actually increasing in price, when in actuality they're buying it back their own selves. Bank of America released a report in April revealing that U.S. companies have borrowed $2.5 trillion over the past 5 years and spent $2.7 trillion buying back their own shares. This is what's going to cause, according to this article, the next stock market crash. Roughly a quarter of share buybacks were done with borrowed funds between 2011 and 2015. Unfortunately, this type of debt still sits on many companies' balance sheets, which impacts investors and could make the next stock market crash coming even worse. The Fed is going to have to bail out corporations. If they're not going to try to allow a massive stock market crash, that is going to be the plan as to how to alleviate that. And they're going to push interest rates back down to zero, if not negative territory, because of the massive debt that these major corporations have accumulated. Okay. Now, investors would rather that corporations start to pay down that debt instead of buying back the stock. This puts companies in a position of having to defend their balance sheets. Whether interest rates rise, making share buybacks less attractive because it costs more money to finance, or it just becomes outlawed by the presidential candidates, a stock market crash could be the end result. Okay, so now this is the reason as to why some see the Fed not raising interest rates, because if they do, then corporations will not finance more debt to buy back their shares. They need cheap money in order to buy back the shares that are in the market. This is the reason why Fed will not increase the interest rates going forward. This is what's going on at Wall Street. And when you look at it, Jerome Powell came out, and many of the market participants are insinuating that that is going to be the case. That's why the market in these three indexes last week saw the market close toward the high of the bar. And we're going to go ahead and start there. We're not going to look at the monthly charts. We're going to look right here on the weekly and see that the market is betting that the Fed is not going to increase interest rates. That's why the market for the NASDAQ, let's go ahead and look at the S&P 500 on the weekly, and then on the Dow, is betting that they will not do it. That's why the market has seen this massive push to go up bar last week on all three indexes. You can see it. This literally tells us that the market participants who are in the know are expecting the market to continue to move to the upside. The last couple of weeks in the market for the NASDAQ has seen a dramatic movement to the downside. If I were to put in a price range, we can see precisely how low the market came when we started the market movement to the downside on this particular week right here. So the market dropped 13.25% to the downside. All right. Now, this last week price bar continues to reflect to us that we're still in a consolidational range. Understand that 7,500 points is a area of resistance. If not that, 76. So we're about 150 points away from those resistance areas respectively. But nevertheless, this last weekly bar, especially since we started out the week moving to the downside, we're closing towards the high of the bar. We got a little bit more leg room to see these indexes move higher. So we are expecting the NASDAQ to move to the upside. 7,500 to 7,600 points would be those areas. So let's go ahead and pinpoint on a daily a simulated buy position in the market for the NASDAQ. All right. So we said all the way up to around 7,600 points. That would be about 2.3% 28% movement to the upside. Downside support has to be maintained, I will say, around 7,300 points. So this is what we're going to utilize going forward in the market for the NASDAQ. We are expecting some potential movement to the upside, and I'm seeing it. 7,500 to 76. Understand, I will be taking simulated profit in this particular index if it hits 7,500 points. All right. Now, the next one is going to be the S&P 500. Again, this index is continuing to reflect to us that the market is proposing to continue to move to the upside. So when we saw that weakness came in on the week of May 6th, all the way back down to the bottom portion of last week, was 7.5% movement to the downside, right? This last weekly price bar insinuates that there's still some anticipation of higher prices, but overall, the long-term trend, we're still seeing some consolidation of trading. But nevertheless, we're going to anticipate the market in the S&P 500 to continue to move to the upside. All right. Now this last day in S&P 500 did insinuate some sellers coming to the market. So we have to anticipate that to happen. Now, in order for this simulated trade to go right, the market in the NASDAQ cannot break below 28.25, give or take. Okay. The resistance area currently for the S&P 500 is right here around 2,900 points. That literally can be, and I'm seeing the market trying to hit that 29.20, 29.15 set price. Price in order to see some resistance to come back into the area. So we are seeing some indications that the S&P 500 is trying to continue to move to the upside, and that is what we're going to anticipate. All right, so this is our anticipation for the S&P 500. Now we're going to go ahead and look at the last one, which is going to be the Dow. Again, quick price range to see from the top of when stockpile came to the market on the 29th of April all the way to the bottom of last week was again about an 8% movement to the downside. Last week, the market for the Dow have seen another massive push to go bar in the space. Tells us that the continual movement to the upside is still in play. Like literally this one weekly bar has encompassed the last 3 weeks of trading in the Dow. That definitely insinuates that this particular index has higher prices to contend with, and we're going to pinpoint that for you right now of our expectation of what we want the Dow to do. So the last couple of days in the market, especially last week, this has been a massive movement to the upside in the Dow. Literally, it insinuates that it was a fake movement to the upside. But overall, it is still insinuating that we might see a little bit movement to the upside in this particular index prior to resumption to lower prices. Now, obviously, I would like 25,750 points to be maintained as support, but that's not a logical thing to see considering the volatility that is coming into the market. So I would say around 25,500 points to be a support area in the market for the Dow, and the target price is going to be right here around 26,250 for resistance. Okay, now if any positive news come into the market concerning the escalation reduction in China trade war or even in Mexico, these three indexes can continue to see a massive movement to the upside. All right, so I'm going to anticipate the market in the Dow just to move a little bit higher, maybe around 1.63% moving to the upside, and then it will have to be readdressed again to see whether or not the strength is being maintained in these three indexes. So right now, these three indexes are still insinuating some continual movement to the upside. We have pinpointed what we expect these indexes to do. Give us your thoughts, give us your opinion as to what you think. Will stock share buyback programs being restricted or even eliminated start the next stock market crash? Give us your thoughts, give us your opinion. Make sure you check us out at our website, HueFinancial.com, in order to get more of our analysis. Make sure y'all maintain profitability, and I will talk to y'all later.